Hi, welcome to Russell Investments Market Week in Review for the week ending August 16th. I'm your host, McKenna Painter. Tuning in with me today is Director of Investment Strategies, Shay Kshatriya. Shay, how are you doing today?
I'm pretty good. How are you, McKenna?
Doing awesome. Okay, let's dive in. There's been tons of macro data this week for the U.S. with inflation and retail sales, the featured data points. What's our take and market reaction to those?
So there is a lot to unpack, and it's been a pretty volatile couple of weeks. The market sold off 2 weeks ago due to concerns about the growth outlook as the July employment data disappointed, and there were other technical factors related to the yen carry trade. However, the data since then has been encouraging and has supported the markets in recovering most of the drawdown, with the S&P 500 as of Thursday's recording roughly where it was at the start of the month. And this week's data points were clearly supporting the broader recovery narrative. So if we start with the feature data point, which was inflation, which came in roughly in line with consensus expectations, with the headline increasing by 2.9% in July. And this is the first time the headline CPI was below 3% since March of 2021, while the core also moderated to 3.2% on a year-over-year basis. Moreover, we also had producer price index for the month of July also released, and producer prices also moderated, which is important because producer prices ultimately feed into consumer prices, and it also informs the Fed's preferred inflation gauge, the PCE price index. So clearly, good news on the inflation perspective, but there was also good news on the consumption side, as well as the health of the labor market, right? So retail sales for July were stronger than expected in the headline, as well as the control group. The control group, think of that as core retail sales, and it's important because it feeds into GDP calculations, while the initial weekly jobless claims, those are filings for unemployment insurance during the week. They moderated relative to the previous week and also were below the consensus forecast. So that indicates that the labor market is clearly slowing, but in a measured way. So the data has generally been pretty supportive after the hiccup from a couple of weeks ago.
All right, sounds like we're all over the place with the market these days. It's been a roller coaster the past couple of weeks. What are the implications for the Fed now?
Yeah, for sure. And clearly, the roller coaster has whipsawed markets' expectations about the Fed outlook. And that's in large part because of the volatility and the growth scare that was getting priced in. So, what's interesting is if we just rewind the clock about a couple of months, and market expectations at that time were just for about one rate cut. Now, one rate cut for the balance of the year didn't seem quite right to us. But then, of course, it swung wildly because of the growth fears all the way to five rate cuts, which seemed a little bit too aggressive from our perspective. So our view has been more steady throughout. We did raise our outlook for the Fed in terms of the number of rate cuts from 2 to 3. Now the markets at this point have gradually shifted towards our view to roughly around 4 rate cuts is where the markets are. So what we believe is that the Fed will likely cut 25 basis points starting in September and the remaining 2 meetings thereafter. So 3 rate cuts of 25 basis points each. Now a 50 basis point move, which has been debated in the markets, it's possible. But the precondition for that, we believe, is a weakening labor market. So labor market fundamentals will be a crucial watch point as it relates to the Fed outlook.
Well, it sounds like there is a lot of change going on with the labor markets. Okay, going across the water, it's been a busy week in the UK, which also released its inflation figures and employment. What are the implications for the Bank of England?
Yeah, for sure. So this was an important week with inflation and employment, as you mentioned. So if we start with the inflation data for July, the headline CPI increased 2.2% and core prices rose by 3.3%. Now, thankfully, both were below expectations, so that's clearly good news on the inflation front. Now, as far as the labor market data, there was a bit of a conflicting information. With the June employment report was actually stronger than the markets had expected, and with the UK economy adding more jobs than anticipated, and the unemployment rate actually falling to 4.2%. However, there was a bit of a caveat in that there was a significant increase in the claims for unemployment benefits for July, which does suggest that there could be a potential cooling down the line. So what does all this mean for the Bank of England? The BOE, when it cut rates in the August meeting, it was a pretty close vote as it was. So the markets were expecting a skip at their next meeting, but thereafter, about 2 rate cuts for the balance of this year thereafter. And that roughly is in line with our expectations.
Looks like the Bank of England is keeping us on our toes. Well, that's a wrap for this week's Market Week in Review. We've had some wild rides and interesting trends these past 2 weeks. Remember, the market never sleeps, so stay informed and keep your strategy sharp. Thanks for tuning in with us, and we'll see you next week for a more in-depth analysis and market updates. Until then, I'm McKenna Painter. Stay savvy and see you soon.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.